With rising sea levels and more frequent flooding, homeowners are facing increasing risks. But is the insurance system really prepared to protect them? How does the current flood insurance system in the U.S. function, and is it hiding the real risks of climate change? Susan Crawford breaks it all down for us.
The story in the U.S. is that the private marketplace long ago retreated from selling flood insurance in America. They thought it was too risky. It just wasn't a business-like proposition. More than 90%, probably 96% or more of flood insurance in America is sold by the federal government. You may be buying it from a private agent, but they're just a pass-through. They're getting a cut. They may get 30% of the premium in exchange for shuffling the paper around, but the risk really sits on the federal government's books. Until quite recently, that flood insurance was not matched to the actual risk of living in flood-risky areas. It was just provided based on maps of special flood hazard areas that the federal government had made up over time. The current system has lots of weaknesses. Often homeowners don't know that even if their property is outside the binary in-out of a map drawn by the federal government, it's still subject to flood risk. Often they don't know that the premiums they're paying are really very low in comparison to the risks. Often they don't know that those premiums cover only $250,000 of a home's value. And there aren't enough people buying flood insurance in America, even though it's mandatory right now for any mortgage to be sold on the secondary market. In the U.S., that's a federal instrumentality. Fannie Mae or Freddie Mac absorb about 70% of U.S. mortgages under a particular amount. In order to be absorbed by Fannie and Freddie in the U.S., you have to have flood insurance. Compliance, not complete. A lot of people, research is divided on this, but many people may not be buying in. And we do see that take-up rates, that's the lingo for this, are low and getting lower for federal flood insurance. So what do we have? A big gap in disclosure, a big gap in coverage, and that shifts enormous risk onto individuals. We saw after Hurricane Harvey that something like 30 to 40% of the houses that were drenched by that hurricane did not actually have flood insurance. And especially if you're a low-income person, it's very difficult to survive, to sort of make it over the course of that storm into your next chapter of your life without insurance. So insurance is supposed to spread risk. It's not an entitlement necessarily. And right now, it's likely that it's being provided at less expense than it should be. It should be more expensive. It should be signaling risk more clearly. And more people should be in the pool so that the premiums both remain in the front of people's minds, everybody's aware of flood risk, and are spread among a very wide population. In the last few years, the federal government has taken a major step forward by ranking properties according to their actual flood risk, not on some binary map-driven standard, but by ingesting a lot of information from the private insurance market about risk, and they call this risk rating 2.0. So there is risk-adjusted insurance gradually coming online in the United States, but still disclosure's awful, take-up rates are low, and people are exposed to rapidly increasing costs of insurance, which particularly for low-income people may cause them not to be able to afford their houses in the long run. So it's a big problem. No matter where you build or what you do, especially development community, there should be insurance that should be available. It is the government's responsibility to make sure that insurance is there. It's a weirdly sort of socialistic, it's both socialistic and individualistic at the same time. I get to build wherever I want, and you, the government, FEMA, will show up no matter what if there's a disaster and take care of me. This is no way to keep people safe. What we should be doing is planning in advance for people to live in relatively less risky areas and in those areas, a private insurance market will likely emerge. If it makes business sense for insurers to be there, they will. We're seeing insurance companies exit from places like Florida and California, replaced by more fly-by-night insurance companies, maybe not as solvent, maybe not as likely to be around in the long term. And it should not be that the answer is to just shore up that market by making sure there's some state insurance fund that's available. Because all you're doing is making a money machine roll that benefits developers, but in the long term doesn't benefit society.